You're watching Business Edge, and now to our first conversation. Pension fund administrators have increased their investment in Nigerian equities and Treasury bills by 48.04% year-on-year to 3.35 trillion naira in May 2025. This rise is up from 2.26 trillion naira in May 2024, according to data from PenCom. This surge contributed significantly to the pension industry's total net asset value, which rose to 24.11 trillion naira. Analysts attribute this growth to strong stock market fundamentals, attractive NTB yields above 20%, and improved investor confidence in CBN policies. PFAs' increased participation also lifted market capitalization by 7.7 trillion naira in 5 months. Experts believe reforms, easing inflation, and undervalued stocks have made Nigeria's capital market more appealing to long-term investors. We have joining us now Head of Fixed Income, FX, Chapel Hill Denham Securities Limited, in person of Oladipo Ajayi. Good morning and great to have you in.
Good morning, John. Thank you very much for having me this morning.
It appears business continues for you even on the holiday. But let's get into today's conversation with the rise and the surge in PFA's investments in domestic stocks and Treasury bills. What do you think is boosting this confidence, and what are the factors driving this 48% year-on-year surge?
Well, I think we'll start from the policy of the government to actually take a proactive action around harmonization of the FX window, and that's actually one way or the other restored confidence in the market by foreign investors. Because before now we used to have multi-FX window, and there's a lot of price differential that actually bring room for arbitrage opportunity. But when the current government actually emerged, the first thing they did was to actually harmonize the window. So it simply means we now have a unified window where rates can be determined. And towards the end of last year, I think the first week in December 2024, the central bank also introduced the FM FX platform that actually brought about transparency in the market, price discovery. And when you sum all this together to a great extent, that actually helped to actually develop the market and also bring about that aggressive interest that we saw in the market. And the foreign investors can now come into the market with ease and also exit the market with ease without any fear that they may not able to actually repatriate their proceeds in Nigerian market. That actually led to the aggressive interest we saw in the market. And also another thing is the fact that the devaluation of Naira actually also led to the cheap valuation of the equities market. And a lot of foreign investors can see clearly that Nigeria market is heavily underpriced and there's a lot of value in that market. And so also domestic investors too can actually see clearly. And at the beginning of this year, when you look at the NTB rate, a discount rate of about 22%, effective yield of about 28%, it simply means that it's a risk-free investment of 28%. That is a no-brainer for any investor because you know that there's no inherent risk with that. This is more like government instrument, and investing in it, you get a 28% return. So, and that is one of the reasons why we notice that aggressive interest in the Treasury bill space, even by PFAs. A lot of them are actually very, very active in the Treasury bill space. Imagine at the beginning of the year, we are getting about 28%. As we speak currently, the rate has dropped by close to about 800 basis points to about 20% now. Even a 20% is still very much attractive for anyone still looking at to invest. As at 2023 January, rates were around 8% discount rate and about 10% effective yield. So when you compare the period and now, it means that the market is still very attractive. And that's one of the reasons why I've been seeing influx of investment into the equity space, influx of fund into the NTB space to actually capitalize on this available returns.
I mean, very interesting developments there. And we're seeing the spread between, the local bonds, NGX, Treasury bills, fixed income assets. There are rising concerns, though, that, Treasury bills, they're seeing a decline in yields, right? But, it's slipping below 19%. What are your thoughts on this? And do you see that sort of taking the shine, or do you see investors rotating from the fixed income side of things to more the capital markets, that is stocks?
Well, currently yields are actually dropping, and the market is basically forces of demand and supply, and also the body posture of the DMO is also a factor that you need to reckon with. When you look at the calendar released by the DMO is not showing any aggression to actually increase borrowing aggressively in this quarter. When you look at the bond auction calendar that was released, the DMO will be doing average of 100 or just 100 billion per month. And when you compare to what we have seen in the past, we've seen an average of 100 billion per month. So it simply means that the DMO is not in any haste at all aggressively looking at borrowing this quarter. So when you look at this, it simply means that we'll continue to see rates actually slide, because it means that there will be depth of supplies into the market. And what that will mean is that that will actually further push rate down. And the other exit opportunity for investors will be to actually visit the capital market. And when you look at what's currently happening in the private capital market, a lot of these instruments are still very, very cheap. When you look at what happened to most of these consumer names last year, a lot of them traded at a very low level because of the FX crisis that they actually had in 2023 and 2024. But we are now seeing re-rating of some of these instruments in the market. When you see names like NASCON, names like Dan Sugar, names like Nigerian Bills, names like Guinness, Cabri, you can see that most of these names, they have actually gained aggressively this year. Some of them have even done close to about 100% return in the year 2025. So it simply means that we'll continue to see more of like a shift in investment strategy by some of these portfolio managers. Some of them will now be moving some of the funds into equity market so as to continue to actually maintain that high double-digit level. So and also to be able to actually capitalize on the available investments in the market.
I mean, the equities markets are really taking the shine. But let's come to what is informing the DMO's, slowdown, right, when it comes to borrowing. What would you say is informing this? And obviously with the CBN policies, let us into how that, they're holding rates. We await what will happen this month with rates, but investors are speculating, or analysts are speculating a further hold, several holds that will eventually lead to a reduction. Give us a picture of what this means for the markets overall.
Well, the expectation for this month's MPC meeting is it will be too early for the monetary policy guys to start doing rate cut. I think the earliest we can have a rate cut will be September. And so for this month, we expect the monetary policy guys to actually sit down and watch again and give it time to actually see further impact of the policy that they actually put in place. And when you now compare that to where we were coming from, there's a bit of confidence in the policy of the central bank. We're seeing a lot of even foreign investors actually trusting the Central Bank of Nigeria, considering some of the policy that they have actually churned out into the market. And on the part of the DMO, I think one of the reasons why we're seeing a bit of slowdown in borrowing or aggressive borrowing is I will actually link it to the statement actually released by the Minister of Finance that we've seen increase in revenue generation by close to about 40%. So it simply means that we've actually generated about 40% above what we actually expected. So what this will mean to the market is that the DMO on their part may not necessarily want to actually continue that borrowing spree, knowing fully well that on the revenue generation side, there have been improvements. So it simply means that on the debt side, we may need to actually slow down. And that's one of the reasons why we saw what we are seeing this quarter. Of course, when you look at the precedence. Before now, we tend to see this slowdown towards the end of the year. But now seeing this from the third quarter also makes the market to believe that it simply means that by the time we get to fourth quarter, I will further see aggressive cut in borrowing spree on the part of the DMO, and that will further actually drop yield in the market. And that's one of the reasons why most of these portfolio managers now are now shifting their focus from debt markets into more equity markets, because currently we'll still have a lot of these underpriced instruments in the market that can actually still give a better return than what the Treasury Bills or a bond market would give.
Exciting times indeed. Let's turn our focus to the PFAs, right, and their participation, their increased participation in the stock markets. Do you see, what impact is it having on market capitalization, and do you see this being a trend that is sustained?
Well, when you look at PFAs, they are the biggest portfolio managers in Nigeria. And before now, we tend to see them be extremely conservative. Before that, you tend to see most of their portfolio actually sitting in government instruments. At the time, we have close to about 80% of their portfolio sitting in government instruments. As we speak currently, it's just about 62% that's now currently in government instrument, and you have close to about 10% in all corporate instruments, and over about 12% in the equities market. And one of the impacts of their this shift in investment strategies, what we have seen in the market. We have seen the NGS index actually moved up aggressively because there are a lot of influx of funds into the market to actually capitalize and take advantage of the underpriced valuations in the market. So the influx of some of these funds from these PFAs has actually helped the market actually grow by about 7.7 trillion just this year alone. And now just imagine that they now actually increase their allocations to maybe about 15%. Of course, it simply means that Nigeria market may likely be the most or the best performing market globally this year if we continue in this stride. So I think it's a very good one for most of these portfolio managers because what it will mean is that by the end of the year, when they're actually reporting their performance, we'll see high-level double-digit performance on some of these PFAs, and that would be on the other hand also will also mean that a better return to contributor to some of these funds. Because don't forget that some of these funds that we are talking about, they are funds of people that actually currently working or retiring.
Right.
So it simply means that this year there have been a very good return to their investments, and that will also mean a better valuation for their total holdings.
Yeah, and as you have pointed out, these are the funds of retirees. And while it all seems optimistic, right, it would be, very simplistic of us to ignore the risks. So briefly, in a minute, please, what would you say are the risks, right, of increased PFA exposure to volatile markets, right? What are your thoughts on this? Are there any risks involved in this? Or should they be a little more conservative with the investments?
Well, I think the risk involved is just the market risk, and for retirees, and that's one of the reasons why we have buckets for each of these segments of contributors. For retirees, their investment is purely in government instruments, and government instruments risk is close to zero. So it means that for them, they are not exposed to that volatility that's happening in the capital market. It's only people that are actually more like in the default, maybe bucket 2, bucket 3, that are actually exposed to a bit of equities markets, and these are the people that will actually be exposed or be affected by the volatility that we may likely see in the market. So for retirees, one way or the other, they are actually insulated around what will happen in the stock market. But for those people that will actually be affected, of course, they have a long horizon in the bucket, and it simply means that when we see a bit of retracement in the market price, the valuation may actually drop. But the long term, considering that we know that currently this Nigerian market is heavily undervalued, the long-term goal is that a lot of funds will continue to come to the market and will continue to see higher valuation in the equity market.
All right. Thank you very much for your time today and your perspective on the conversation. Oladipo Ajayi, Head of Fixed Income FX, Chapel Hill Denham Securities Limited.
Thank you very much, Joanne, for having me this morning.
A pleasure.